you're watching gold. And it's not just inching higher, it's racing toward levels most analysts never expected in their lifetime. And when you hear $5,000 being thrown around, you need to stop and understand why this is more than just a market move. Gold approaching $5,000 per ounce isn't about speculation, hype, or a short-term squeeze. It's a warning signal, a flashing red light in the global financial system that the dollar, the backbone of international trade, may be losing its grip on stability. And this isn't something that appears overnight. This is decades of policy, printing, debt accumulation, and global coordination converging on a single point where confidence in fiat is being tested like never before. Investors, central banks, and even entire nations are watching gold not just as an asset, but as a thermometer for the trust and health of the US dollar. Every time gold makes a new high, it's a statement. The market is questioning the credibility of the world's reserve currency. And that question has ripple effects far beyond the metals market. When gold moves like this, it forces a chain reaction. Hedge funds rebalance, sovereign funds diversify, corporate treasuries hedge, and ordinary investors get caught between fear and opportunity. But here's the critical insight. This isn't just price, it's psychology, positioning, and policy converging in a perfect storm. The dollar's apparent strength on paper belies the underlying pressure points: growing deficits, historically high government spending, ballooning debt to GDP ratios, and a Federal Reserve walking a tightrope between inflation and liquidity. Each announcement, each policy statement, each rate decision now carries outsized significance because the market knows the structural risk is real. When gold approaches $5,000, it's not hyperbole. It's a reflection of the systemic tension between currency supply, fiscal responsibility, and global trust. And it's not only U.S. policy that matters. The world is moving in unison, or sometimes in subtle opposition, recalibrating reserves, currencies, and hedges. China is quietly accumulating gold while reducing dollar exposure. Russia is doing the same, simultaneously strengthening its energy trade leverage. Emerging economies are hedging against dollar dependency, because when a global currency wobbles, the effects are immediate, pervasive, and often chaotic. And while this plays out over months and years, the markets are already pricing in expectations, running ahead of reality. This is why you see gold moving sharply even when the news seems neutral. The price action isn't irrational, it's anticipatory. Investors who understand this aren't chasing charts, they're reading signals embedded in flows, positioning, and global policy decisions. And here's the nuance most people miss. When gold hits these extreme levels, it's not a straight climb. It's a wave. A series of surges and retracements, violent yet structured. First, you get institutional accumulation, quietly building positions in futures, options, and physical holdings. Then you see volatility spikes as short-term players react to headline noise. Then you see strategic buying by sovereign funds, which can absorb entire market moves without tipping their hand. And finally, public panic enters, creating liquidity squeezes that amplify every move. If you're trying to time this like a day trade, you're already behind. This isn't a market that rewards reaction, it rewards foresight. Now let's talk numbers, because $5,000 isn't arbitrary. It represents a psychological threshold where gold stops being just a metal and becomes a commentary on monetary policy. At that level, every ounce of gold purchased is also a vote of confidence, or a lack thereof, in the dollar. And that vote carries weight because it signals to central banks, governments, and multinational corporations that the traditional reserve currency may no longer be sufficient for global risk management. And when confidence shifts, it doesn't just affect trading desks, it affects procurement, debt issuance, cross-border contracts, and the pricing of everything denominated in dollars. That's why a spike in gold isn't just an isolated event, it's a systemic stress test. The dollar doesn't collapse in isolation. It collapses against a backdrop of shifting reserves, political pressure, trade negotiations, and market positioning. And gold is the first to respond because it's liquid, globally recognized, and universally trusted. But don't mistake volatility for randomness. Every surge, every pullback, every spike in volume is information. It's the market telling you where leverage sits, where sentiment is anchored, and where institutional players are positioning themselves ahead of a potential broader dollar revaluation. And the timing of this movement matters. This is not a single-day panic. It's a sequence unfolding over months, sometimes years, with each policy announcement, debt issuance, and central bank adjustment contributing to the cumulative effect. Traders and investors who ignore this sequence are reacting, not anticipating. And anticipation is where real opportunity and real protection lives. Now, some skeptics will point to historical gold rallies, argue that the dollar has survived crises before, and claim that high nominal gold prices are just a reflection of inflation expectations. While partially true, they miss the broader structural pressure. This is not merely about price levels. This is about the erosion of trust, the anticipation of systemic risk, and the reallocation of global capital away from a currency that has been assumed safe for decades. And that assumption is under attack. Sovereigns are hedging with physical metal, ETFs are accumulating gold-backed positions, miners are being repriced as strategic assets, and large financial institutions are quietly adjusting exposure to dollar-denominated risk. The coordination or apparent coordination among these actors is enough to trigger waves in price that can seem extreme, even before any formal crisis manifests. And yet, gold's rally is self-reinforcing. The higher it goes, the more attention it draws. The more attention it draws, the more capital seeks protection. And the more capital seeks protection, the higher it goes. It's a feedback loop, subtle at first, then overt, and finally explosive once liquidity is compressed and supply constraints become visible. This is where ordinary investors often get trapped. They see the volatility, they panic, and they misinterpret it as market noise rather than a structural signal. But those paying attention to flows, positioning, and policy will see opportunity, clarity, and guidance in the same movements others dismiss as irrational. And here's the kicker. Gold approaching $5,000 isn't just about fear. It's about insurance, leverage, and optionality. It's a hedge against fiscal mismanagement, currency debasement, geopolitical risk, and institutional failure. And when the world collectively senses these risks, gold becomes the preferred conduit for value preservation. It's why even minor central bank announcements, subtle shifts in Fed tone, or trade disputes can accelerate the move. Every piece of news is magnified because it feeds the narrative that the dollar's position is under scrutiny. And for those who understand the nuance, each spike, each pullback, each volume surge is a data point, a signal, and a trigger all at once. The pattern is consistent: initial move, temporary retracement, structural positioning, final breakout. And in that final breakout, the difference between preparation and surprise can be hundreds or thousands of % in realized opportunity or disaster avoided. Now you might ask, why now? Why gold? Why $5,000? Why this level of panic and anticipation? The answer is multi-layered. First, fiscal stimulus and debt accumulation have created long-term expectations of devaluation. Second, alternative reserve strategies by other nations are creating asymmetric pressures on the dollar. Third, the market has been anticipating tipping points in real yields, inflation, and currency flows for months, if not years. And when those forces converge, gold reacts ahead of the curve because it is the most liquid, globally accepted, and immediate measure of confidence. And it's not just investors watching. Policymakers, regulators, and financial institutions monitor gold closely, not for trading purposes, but as a barometer of systemic stress. And that monitoring itself affects the market, creating a feedback loop where attention fuels movement, and movement reinforces attention. This is why traditional technical analysis often fails here. Charts don't capture policy, global flows, or strategic positioning. Price levels alone are insufficient. You need to understand the structural narrative, the sequence of events, and the incentive alignment among major players. That's where insight, preparation, and strategy come into play. And here's the critical point. When gold hits $5,000, it forces a rethink across every asset class. Equities, bonds, commodities, even digital assets are repriced relative to a dollar that is under stress. Risk models are recalibrated, portfolios are hedged, and capital moves toward perceived safety. It's a systemic ripple effect, and missing it isn't just about lost profits. It's about misaligned strategy in a changing global order. And the ripple doesn't stop with gold. Silver, platinum, and other precious metals follow the same trajectory, but gold leads because it is the ultimate currency hedge. Currency markets, commodity markets, and equity markets all adjust in response, and the timing of those adjustments is often unpredictable. Yet the signals are there, encoded in volume, positioning, and global capital flows. It's subtle, but it's precise. And this is why paying attention rather than reacting is the difference between being a passive observer and an active participant in what may be the most significant monetary event of the decade. Now here's the part that most people overlook. Gold at $5,000 doesn't happen in a vacuum. It's not merely an isolated price movement. It's the cumulative effect of leverage, liquidity, geopolitical tension, and policy signaling all hitting critical mass simultaneously. Every ounce traded at these levels represents more than investment. It's a message. Hedge funds, banks, and sovereign wealth funds are not just buying metal. They're signaling to each other, the market and governments, that confidence in fiat is being questioned at the systemic level. And those signals ripple in ways most retail investors can't see. Swaps are restructured, derivatives positions are adjusted, options hedges are recalibrated, and physical delivery chains are scrutinized for vulnerabilities. Institutional positioning alone can create price distortions that look irrational to anyone observing a simple chart. But in reality, it's the anticipation of a structural dollar realignment being priced in. And here's why timing is everything. When these institutions move, they do so incrementally, often over weeks or months, masking the underlying pressure building in the system. You don't see the structural shift all at once. You see it in waves of volatility, in subtle increases in bid-ask spreads, and in persistent accumulation in futures and ETFs that may seem minor at first. But over time, these micro-adjustments compound, creating momentum that can carry gold far beyond levels that seemed reasonable just months ago. And the psychology behind this cannot be overstated. Confidence in the dollar is not just about interest rates or inflation. It's about perception, trust, and relative value compared to other options in the global system. When the market perceives a realignment, even before it happens, gold moves first. It's why central banks are quietly stacking metal while publicly appearing neutral or committed to dollar stability they are hedging. And the market is pricing their hedging behavior long before any crisis manifests. And that creates an unusual paradox. The price rises because people are worried about the dollar, but that same price rise feeds further concern because it validates the fear. It's a self-reinforcing loop that can accelerate faster than any simple economic model would predict. And that's why volatility at these levels is the new normal. Expect violent swings, sharp reversals, and periods of irrational consolidation, all while the underlying trend continues. Traders who are only looking at short-term patterns will misinterpret this as indecision or noise. It's not noise. It's structural information encoded in price, volume, and timing. You have to read it as a narrative, not a chart. And this is where the distinction between physical gold and derivatives becomes crucial. Physical gold represents ownership, free of counterparty risk, tangible assurance that value exists independent of any financial institution. Derivatives, futures, and ETFs offer leverage, liquidity, and exposure, but they are also subject to settlement risk, margin calls, and systemic pressure. At $5,000 per ounce, the interplay between these two forms of exposure can create dramatic feedback loops. Shorts in paper gold get squeezed, futures margins spike, and the delivery system itself becomes a point of contention, creating temporary dislocations between spot, futures, and physical prices. And while this may seem technical, it matters because the story of gold at $5,000 is as much about mechanics as it is about economics. Supply matters, demand matters, but so does infrastructure, vault availability, transport logistics, insurance, and settlement chains all contribute to market behavior at extremes. And when physical gold becomes scarce, premiums widen, creating yet another incentive for accumulation, and another signal to the market that the dollar is under pressure. Now, look at history. Every major dollar crisis in the past 50 years, whether it was post-Bretton Woods, the 1970s stagflation, or the 2008 financial crisis, was preceded by subtle accumulation in gold, spikes in volatility, and institutional positioning ahead of public panic. The mechanics are always the same. Institutions move first, public sentiment follows, and the dollar's credibility is tested in real time. This is exactly what we are seeing now, but with a new layer of complexity, global coordination. Emerging economies are no longer passive observers. China, Russia, and others are actively adjusting reserves, diversifying away from dollars, and hedging against systemic risk. That changes the dynamic entirely. This isn't just a domestic U.S. issue. It's a global structural shift. The dollar's role as the world's reserve currency is being questioned, and gold is at the forefront of that signal. And this leads to an important point about market psychology. Extreme levels like $5,000 per ounce do not just reflect financial risk, they reflect geopolitical risk. Every trade, every allocation, every position is informed by expectations about trade disputes, sanctions, reserve diversification, and energy leverage. When central banks and governments start positioning in gold, they are not reacting to charts, they are reacting to global stability. And that's why retail investors need to understand the broader context. If you are only watching technicals, you will see only swings, gaps, and candles. But if you understand policy, leverage, and global flows, you see a narrative unfolding that is far more predictive than any pattern recognition tool. And let's talk leverage for a moment, because it is a critical factor. When the dollar shows stress, leverage in derivatives and futures accelerates moves. Margin calls force positions to liquidate, creating volatility that can be mistaken for panic or irrationality. But it is the natural byproduct of structurally misaligned confidence in currency. Institutions anticipate this. They use it strategically, front-running flows, absorbing liquidity, and positioning themselves for the broader shift. And that creates yet another feedback loop. Volatility begets accumulation. Accumulation signals structural pressure validates the trend, and the cycle continues. This is why gold's path to $5,000 is neither linear nor accidental. It is the sum total of decades of economic policy, debt accumulation, global coordination, and market psychology coming together. And it's also why predictions about imminent collapse or inevitable crash are often misleading. The market does not collapse overnight, it recalibrates. Waves of pressure accumulate, and tipping points are approached with precision. The narrative and the mechanics must align for the move to reach these extreme levels. And here's the practical takeaway. Positioning is everything. If you are early, you can protect wealth, leverage upside, and participate in structural realignment. If you are late, you risk being caught in dislocations, forced liquidations, and premiums that make entry costly. Gold at $5,000 is not a signal to panic. It's a signal to understand, anticipate, and execute with discipline. And discipline in this context means watching flows, tracking institutional positioning, monitoring geopolitical shifts, and separating emotion from opportunity. It's about recognizing that every spike, every retracement, every surge in volume contains information about systemic stress and potential reallocation of global capital. And that brings us to the broader implications for other markets. If gold moves, the dollar moves. If the dollar moves, everything denominated in dollars, stocks, bonds, commodities, crypto, adjusts in response. This isn't theory, it's observable behavior. Every major dollar adjustment in the past century has rippled across all markets, and gold has consistently been the canary in the coal mine. But today, the interplay is faster, more connected, and more globally visible. That means volatility in gold translates into volatility elsewhere, even before traditional signals like interest rate decisions or fiscal announcements. And yet, the opportunity is not just in price, it's in structure. Understanding where supply chains, institutional positions, and physical flows converge provides insight into where the market will move next. Because gold at $5,000 is not just about fear, it's about anticipation, leverage, and allocation. And allocation is global. When sovereign funds, hedge funds, and multinational corporations shift even a fraction of their holdings toward gold, the impact is magnified due to the size of the positions and the interconnectedness of the system. Physical scarcity, delivery constraints, and liquidity risk amplify price moves, creating scenarios that appear extreme to retail investors but are rational within the structural framework. And this is why the story of gold near $5,000 is as much about finance as it is about human behavior. Confidence, fear, perception, and anticipation all converge in a single, liquid, globally accepted asset that acts as both a barometer and a hedge. And understanding this dual role is crucial for anyone looking to protect or grow wealth in a system under stress. So, what should you do? Not panic, not chase, not rely solely on charts or headlines. Focus on sequence, positioning, and risk management. Understand where structural stress points are. Recognize the role of policy, leverage, and global coordination. And above all, differentiate between physical ownership, derivative exposure, and strategic positioning. Because when the dollar is under pressure, these distinctions matter more than ever. Physical gold provides security and optionality. Derivatives provide leverage and exposure, but also systemic risk. And the difference between success and failure often lies in understanding which tool to use, when, and why. And finally, this is about more than just dollars and gold. It's about understanding the architecture of global finance, trust, and systemic stability. Every decision, every trade, every hedge is a reflection of expectations about confidence, policy, and liquidity. And when those expectations shift, markets react violently but predictably, if you know where to look. And that's exactly what we are seeing now. The market is signaling, institutions are positioning, and gold is telling a story about the dollar that cannot be ignored. The price is not just a number, it is a narrative, a signal, and a reflection of systemic stress converging at a single point. And as that narrative unfolds, those who understand the mechanisms, the incentives, and the flows will have clarity, while others are caught chasing prices and misinterpreting volatility. And that, more than anything, is why gold near $5,000 is a warning, an opportunity, and a message all at once.